U.S. Treasuries took down.
Listen up, Rebels. Rebel Leader here, and today we're going to go over a weekly debrief. What happened during the week? It was a big earnings week for a lot of retail investors. We're going to talk mainly about Palantir, Tattooed Chef, and even Airbnb. There was, a huge for the past, the MO for this entire earnings season has been great beats on earnings and revenues, but the stock still fell because of guidance, right? It was basically the same this entire week. A lot of stocks, if they didn't fall, they stayed the same. And there was no big move upwards because, nobody really knows what's going to happen with this Delta variant in the fall and winter. And also they're saying that all these, a lot of tailwinds happening, or a lot of headwinds right now about shipping prices due to COVID being really high, packaging, and supply shortages. And again, this is all because this was all anticipated for the past year, as people want to start doing business again in COVID. These just the cost of doing business at this time, and hopefully it'll turn into tailwind as soon as early next year. So right now we're seeing profit margins that aren't as solid as we would hope, and that's what we saw in Tattooed Chef. The earnings were not good. They missed by about $5 million. They came in way under, and then not only that, the guidance for the future wasn't too good. Now, what that means is that the long-term plan is still solid. Nothing has changed in the fundamentals of their business, and they were even able to actually beat on their number of stores that they got into, and that's good to see for an expanding business. In particular for a growing company like Tattooed Chef. These earnings expectations and estimates, it doesn't really matter if they're in a hyper growth stage like they are right now. Of course, they're not going to be profitable. Of course, they're not going to do these crazy numbers right now. So nothing scared me away from the stock currently. If anything, it dropped down from 20 to about $17, $18 a share. Well, listen, it was just a few months ago at $15 a share. Like we've been here, we know that this is pretty much the range it's going to trade at until it blows up, until it goes to the moon, right? It's going to be this $15, $20 range, and you can keep picking it up if you want. I currently, will buy this dip a little bit more, maybe make it, one of my top three positions, one of my top positions, top position maybe. But, this is, again, a long-term steady play with lots of growth in front of it, and nothing has changed about the growth momentum that it's having. So as we see, Tattooed Chef, it's not bad. It's not bad. It's not good. It's not good that they didn't do great revenues in the end. It's not good, but it's not bad that they missed because they're in a hyper growth stage. And next quarter, everything fluctuates quarter to quarter. They had an amazing quarter one earnings. Quarter two earnings was not so great. Quarter three and quarter four, you got to think long term here. One quarter doesn't mean much. It doesn't really mean anything in the grand long term scheme and business plan that Tattooed Chef has, right? So I also want to talk about some great earnings, which was a surprise to everybody. Was Palantir. And if you actually look at Palantir's numbers, this is what it impressed me. It was very impressive that the numbers that they were throwing out there, that they were able to get in for government contracts, for revenues, where they thought they would be at the end of this year versus where they are right now. I think they beat all forecasts of what they thought they could do in only half a year, and the year isn't even over. So I think people are seeing that Palantir is now not only a legitimate business model, but it's extremely sticky with governments, and it's just crazy how their business model works, because they give a free trial for any government entity that wants to use it, and after maybe a month or 2 month or 3 month period, and after that, it's up to the government. It's up to the company or entity if they want to continue with Palantir services after they prove their worth. And this is something that the software is AI, it cannot be replicated, right? The barrier to entry is almost impossible, and also that Palantir has such a strong advantage, a head start advantage against all these other AI companies, and they have these government contracts that are just going to keep renewing and being sticky. But Palantir not only cemented itself within a lot of retail investors. Now we're going to start seeing a lot of Wall Street money coming into the stock. It beat on earnings, beat on revenues, and the outlook was actually quite amazing. But it's traded sideways, meaning that it only went up, I think, what, 15% yesterday, because on earnings release like that, but the numbers that they were throwing out there, it should have been a lot more. And this just pretty much cemented, it confirmed, you know, basically all my bullish thesis on the stock. Nothing really again has changed. Uh, how I felt before. If anything, just impressed. The numbers were really good. It was really strong. If anything, it just makes you grow more confident that going from $20 to $25. It's that's not why I'm in this stock. I'm in this stock because I believe it can go up to $100, right? $100 a share. That's kind of where I kind of got in on it at, and it's right on track. It's good to keep them, to keep seeing momentum and progress, because we're getting there. It's not going to be an overnight thing, but it will get there. And they're building out this business, and it's going to keep getting stronger and stronger over the years. Where we're going to see at the end of this year in quarter 4 earnings, where Palantir will be is going to be huge. It's going to be, I think it's going to be a very strong momentum gainer, and I think it can really run at the end of this year if they get really strong 2021 financials. They really show what their company is worth. It could really start running as early as late this year, early next year, and you might even need to wait as long as 3 to 5 years to start seeing these great, huge gains from Palantir, because they're proving themselves, and they're proving. Wall Street likes companies that can prove themselves, and this stock just ran up to this stock used to be a $40 a share stock, without proving anything just a few months ago, right, early this year. Now they're proving their worth. Not only and then they dropped down to $20. People start buying heavy. Now they're $25, and now they're proving themselves. They get that not only worth that $40 price target, and probably a lot more. So again, this was another one of those kind of rebound plays, but it's a very strong conviction. It's a very popular retail stock amongst retail investors, which is people like you and me that aren't Wall Street hedge funds or anything like that, right? This is just individual investors that they see this company, they see the future of it, and they're getting in on it because they want to be part of the growth. They want to be make money. The last thing is Airbnb. Huge, great numbers. It's still trading at its IPO price. It is kind of crazy to think, because the Delta variant, nobody knows what's gonna happen with travel. Travel has still been great beginning of this half of this year. Maybe there was some pent up demand, but whether or not coronavirus does what it does, I think it's important to note that Airbnb had a great first half of this year. I think Airbnb, everybody knows the story. Almost everybody uses it. And, it's taken over the travel and hotel industry, and it's something worldwide, right? It's an international company, and where we're gonna see this start to take off, I think, is as soon as whenever this pandemic ends. It could be next year, it could be the year after that. Buying now at the IPO price of Airbnb is a solid bet. It's a solid bet against on travel. And if you were any travel business currently, I would say that I would want to buy Airbnb in a stock. Not only they release crazy good numbers, it's still trading sideways. It's still trading at its IPO price. It IPO'd earlier this year. It's still trading at the $150 range. It ran up all the way to like around $250. Could it go back up there again soon? Probably not with all this coronavirus, but now's a great time to buy. Now's a great time to buy up until the moment that the pandemic ends, and then it's going to skyrocket. And the moment it skyrockets, that's not the time to buy anymore, because then you're going to start facing real valuation questions. But right now at this price, Airbnb is probably a steal. Where it's going to be 5 years from now, it's going to be crazy. It's going to be, think about where Airbnb was 5 years ago, and nobody really even used it. Everybody was just starting to think about it. Everybody was just starting to kind of decide between hotels and Airbnb. Now it's pretty much, we're going to go check on Airbnb first, because we want to check, the good prices. You kind of want to see the reviews. You want to kind of see photos of exactly the room you're staying at. That's kind of not how hotels work, right? So so basically, I would say that this earnings season, it's what it was. I think that nothing in any of these three companies I just named, nothing has changed the long term outlook of these companies. And we're getting in and we're buying now in its early growth stages. So we're not going to see and really reap the rewards until, a year or two down the line. But when it runs, when it runs and it, 3x to 5x's, that's what matters. And what matters now in the short term doesn't really matter. Up and down 10%. We're not in the stocks for 10% gains. If we were, we would just put it, in the S&P 500. We put it in a mutual fund. We even maybe just put it all in like a Facebook or Apple or Google, a company. Well, one of the most powerful companies in the world, right? We just throw all our money in there into Amazon. One of those big tech companies where they're only going to move, 10 to 20% a year. That's, if you want that, you can do that. But we're going after, we're trying to 2x our money at least. At least we're trying to 2x our money, and that's why we invest in these high growth stage companies at the very early stages, because then you reap the rewards later when the company grows and becomes that big. And kind of take all of the earnings into account. Always listen to the calls, because again, there was a lot of good things said by Sam Gledy on the Tattooed Chef call. And it's kind of good to see where they see their businesses at, and you have to kind of see also where the Wall Street analysts are coming in and questioning, the business model and things like that. Again, Palantir blew out everybody's expectations, and Airbnb is doing just about the same, even amidst like a crazy, COVID world. So that's it for this week, Rebels. Keep holding, keep buying, during these dips of earnings of stocks you really believe in. Because then when they start running, then you're not going to buy anymore. And Tattooed Chef, it's a good thing that it's a good thing and a bad thing. It's a bad thing for short-term traders. For long-term traders, you think that it dipped. Now is a good buying opportunity because you can keep on buying these stocks until they run up. A good example of this was Revolve stock. Revolve stock, for me, I started buying it at $8 a share. Yes, it was $8 a share just last spring. And now it's and then it ran up to I think $16, and then I bought a ton more at $16 a share. Then it ran up to $20 right before an earnings, and looking at it, I was like, this company is doing crazy good. The future growth of it, was exploding. The numbers were incredible, but it was severely undervalued, right? And then it ran for, so I got a bunch more at $20 a share, and then now it's trading at $60 to $70 a share. Now I'm not really buying it anymore. I haven't bought any more Revolve stock since it hit the $20 price. Now I'm looking at these other stocks, that's kind of that are undervalued, and this is what I'm seeing in Tattooed Chef, Palantir, and Airbnb. These are kind of where now you can't. It's hard to justify buying in to Revolve at $70 a share when we can put there's a better opportunity for that money to really skyrocket in these three companies. Revolve, I'm just holding that. We're not selling, we're not buying anymore. I have a huge position in that already, and that's kind of the growth again for the next 5 to 10 years is going to take over Macy's. It'll take over brick and mortar stores, but we know the story of Revolve. We kind of I talked about that a lot last year. And now, it kind of switches, right? You kind of have to switch gears, and you have to find where the new opportunities in the market are. And for as long as they're there, you have to take advantage of it because they won't stay there forever. And, at the end of this year, we're going to talk about these three stocks again. We're going to, and if we look back at the end of this year, these would be like, it would be crazy not to buy it this time. It's going to be a different point, and if it runs by the end of this year, then it's gone. Then now, and then we'll look for other opportunities, other stocks, and that's kind of just always the game of kind of investing in the stock market, keeping up to tabs on the business trends and really the world news and things like that. So that's kind of a way to kind of look at it. It's a great opportunity, And as long as it extends your opportunity, again, people get paychecks every 2 weeks. Maybe they can only invest once a month. You should be putting in money every single month for entirely reasons like this. That's why the opportunity to buy over the long term always is good. And you have to kind of stop trying to think about short term. Never really, put too much on one quarterly earnings. It doesn't really mean much. Because winners are winners in the long term. You can even just look at Tesla. Tesla lost for years. Tesla's about to go bankrupt. And all of a sudden, boom. A lot of companies. You can look at most successful companies in its early growth stages. They weren't making money, and then it changed. And it changed, and it ran, and it flipped almost instantly. So it doesn't really matter how long you're in it, as long as it ends up running and you have high conviction in your stocks. And a lot of these early growth companies, where they're going to be 3 to 5 years from now, it's nowhere near where they're at now. So that's kind of how you have to value these companies, right? Rev Leader, over and out.